Hey, what's up, guys? Austin the Money here. Sorry I haven't been on in a while. I am in the process of moving. I have been packing up a bunch of stuff. Hopefully, the movers will be here in about a week to pack up and move. I'm moving from North Carolina to Louisiana, so I apologize. But let's get straight to it. I want to talk about today great buying opportunities and could the dip keep dipping? And should you be a buyer right now? Or should you be a hold? Or should you be a sell? So let's dig right into it. First off, we got to talk about valuations, right? Usually when you see sell-offs, it's either because of news or valuations are too high, or sometimes both. This week specifically is because President Trump has tariffs coming in, and it freaks everybody out, right? It might elevate prices in the short term, and it's going to be hard. And we don't exactly know how to prepare for it. So market uncertainty equals, market downfall, especially in tech. Tech is the first to go. So let's take a look at one of my favorite stocks right now. We have Google, all-time highs to where it's at now. We're almost down 19%. That is, you're buying something 19% cheaper than it was. I mean, that is a absolute great discount if you ask me. It's trading at a current PE ratio of 21. Google is actually about to fall under the $2 trillion market cap for the first time in a while. And Google just started a dividend not too long ago. So you're really getting the full package with Google, getting a great valuation. And let's go check on their growth. Let me punch in Google. This is Seeking Alpha, by the way. Love using them. Hit their earnings. Scroll down. All right, so 2025 earnings estimates about to be $9. They're trading at a 2025 PE ratio of 18.95, which is very, very good, and a 2026 PE of 16.63. And their revenue is going to go from 390 this year to 432 billion next year. Let's get a percentage to understand this a little bit better. Okay, EPS is going to grow by 11.78% this year and almost 14% in 2026. So we're getting good double-digit growth at a very good PE ratio. Love to see that. And revenue, also double-digit growth, almost 11.5% down to 11%. So double-digit growth on the top and bottom line, and at a 2025 PE ratio of 19. Very, very good valuation. So if the dip keeps dipping, I don't see Google dipping as much as other companies could. Like, for instance, Apple. I think Apple could continue to dip a lot. I think it's very overvalued. So a 2025 PE ratio of about 33, and 2026 a 29. 33 PE ratio. Keep that in mind. All right, let's go look at their growth percentages. So earnings are growing at 8.7% this year, which puts them at a 33 PE ratio. And 2026, they're growing by 12.35. So average it out about 10%. So they're just making that double-digit line. I believe if you averaged out Google's, it was about 11.5% or so. So Google's slightly beating them on EPS growth. All right, let's check out revenue growth. 4.6%. That is very slow. I think Google's growing 3 times faster than that, their revenue. And then 2026, they're going at 8.1%. I think Google's was like 19%. So they're growing at 2 to 2.5 times faster than Apple. I'm sorry. I don't think Google's was that much. I think Google's was 11 or 12. So Google's growing faster than Apple. About 2 times faster than Apple for 2025 and about 1.5 times for 2026. So Google's growing faster than Apple on earnings and revenue, and they're trading at a 20 PE ratio or 21 PE ratio compared to Apple's 33. So right there, you can really see with Google, you're getting a lot better bang for your buck than Apple. And on top of that, Google is down 19% and Apple's only down 8%. So you're buying at a bigger discount on Google as well. All the way around, I think Google's a great, great company to start getting the dip now. That's what I've been doing. Obviously, I bought in a little early, but I think Google's a great evaluation around 180s, 190s. It's still a great evaluation. Next, let's check out Amazon. Let's check out their earnings. Scroll down. So they're trading at a P ratio of 33.6, which is honestly kind of cheap for Amazon. Amazon used to be trading, like I swear, in 2021, they were trading in the hundreds. It was almost like Tesla, trading in the hundreds. And then recently, they've been into the like 40s and 50s. I think really for the first time in Amazon's near future, they have been in the 30s. I think right now they're at a 38, but for the full year of 2025, they'll be at a 33. 2026 full year, they'll be at a 28, which is great. Revenue's going from about 700 billion to 771 billion. That's a little over 10%. Let's get the exact percentages for you guys. So this is a good comparison to Apple, right? Because Apple's PE ratio for 2025 was about 32.9, so very close to Amazon's 33.6. But they're growing their EPS at 14%, and 2026 they're growing it at almost 20%. So very strong double-digit growth for Amazon, considering how big Amazon is. And revenue, 9.5% and almost 10.5%. So averaging at 10% on revenue. So 2025, I think Apple's was 4.5%, so doubling their growth percentage compared to Amazon. And then, or compared to Apple. And then Apple's was around 8% in 2026, and they're hitting about 10.5%. So for the exact same valuation, they're crushing Apple on revenue and on EPS growth, and they're trading about the same valuation for 2025. Now, 2026, Amazon would be trading cheaper for a forward year outlook. Amazon is cheaper. So I like Amazon as of right now as well, just because they're growing faster. And like I said, they're at a discount right now. So, and the last stock in my portfolio is SoFi. This is a newly profitable company, a fintech, as you will. EPS for this year is supposed to come out at 26 cents. That puts them at a 56 PE ratio. And 2026, they're about to double that to 50 cents. That puts them at a 28 PE ratio. I don't really see SoFi getting down to a 28 PE ratio unless we go into like some crazy recession this year or whatever. But since a fintech company, fintech companies usually don't trade under like a 30 or 40 for their first couple of years, and then their PE kind of averages down slowly, which makes me think SoFi stock has lots of room to explode right now, considering their PE is literally about to get cut in half. And then in 2027, 2028, you're looking at over $1. And $1 compared to a $13 stock right now, that's a 13 PE ratio. So basically, I'm looking at SoFi going to $30-$40 within the next 2 to 3 years, which is on average like 80 to 100% return every single year, if I'm not mistaken, which is why I'm holding this for a good 5 to 10 year play. I think it's going to really pay great dividends holding this stock. This is like my very small cap play, right? You want to anchor their portfolio with the mains. You want to anchor their portfolio with like your bigs like Google and Amazon. And right now, I did put a little bit of money into this. Year to date, I am down 8.5%. This is all unrealized losses. For Google, unrealized of 3,700. Amazon, unrealized of 1,800. And SoFi, unrealized of 888. If you actually look at my realized profit and loss, past month I'm up $2,100, and it's from options. And year to date, I'm up $1,800, straight from selling covered calls and selling cash secured puts. So if let's just say the year ended right now and tax return hits, it would show that I was profitable this year because they look at realized profits and realized losses. So technically, I would have to pay taxes on this at the end of the year, not my unrealized loss of 8.5%. So there's a really big difference between realized and unrealized. So let's see where my profits came from. January 2025, we came in with 1667 from options, which was a 4.93% for the account balance. February 1744, which was a little over 5% for the month. And March, right now, actually, I think I just did some new math. Yeah, I'm at 817. So let me change that real quick. 817. Cool beans. And then I'll plug it in later, but for the combined profit and loss. But you add 3411 to 817, you're looking at about 4,200. If all of my options were to expire worthless right now, then I'd be at about 4,200 for the year so far, which would be awesome. Because my goal right now is just 2% a month or 25% a year with options. And then hopefully with stock gains as well, that would put me well over 30% for the year. The reason that instead of like 3,600, it's showing 1,800 is because when I roll a stock, like for instance, I rolled this put, and when you roll something, it doesn't calculate, it calculates you buying something back, which is a debit. You're paying to buy something back. And then when you sell it, it is an open option, which means it's not realized, which is why it's not showing up year to date. So basically, if all these options went worthless, it would pop up like 34 or something. So yeah, I'm selling weeklies on Google and Amazon just to collect short premium because I see us having a dead cat bounce pretty soon here. Google is oversold on the daily and Amazon is oversold on the daily, and I really don't want to get caught with covered calls if we get a really nice rebound. So yeah, that's kind of why I'm doing that. And this Amazon put is, dude, imagine if I bought this, I'd be up $607, which would be awesome, but I sold it. Not too worried about it because I do want to buy more shares of Amazon. I have a HELOC loan on my house. So honestly, if we get to some really good dips, Amazon and Google are coming close to 20%. If we hit 20% dip on Amazon, I will most likely transfer some money from that loan to buy this dip up, because when we recover, I want a nice recovery, and I really want to experience the full recovery of all these stocks. Because some of these stocks are just so cheap, it's so hard to ignore them. Like I want to buy more Google, but I'm already in so deep right now. Like I can't get any more. I am 20,000 in margin, and then since I sold a 210 put on Amazon, I have 21,000 of option collateral as well. I don't really want to get too much more into margin right there. I still have low risk margin status, so that's not too bad. But I do have more cash on the sidelines. So I have a loan of about $48,000 that I do have access to transfer whenever I want. So it's very important to not have like all of your money in your investing account. You obviously want to have some cash on the sidelines or access to cash on the sidelines, so that when we do get like a 20% market crash, or a 50% stock that you love, like let's just say you love Apple and it dips 50%, you want money to buy that with. Like you have to be buying Apple. You'd be crazy not to buy your favorite stock at a 50% discount. So I'm leaving that cash on the sides for now. I have it as interest only payments. So even if I withdraw 10K, it's only like 100 a month for a payment, which is very affordable to me. So we'll see what happens. So if you guys see my account jump up to like, 50 or something, I probably gave into the loan and invested some more. But this is the portfolio right now, guys. We are down, I'd say, about 10% on everything. But year to date, we are up with the realized and down on the unrealized. Today was a brutal day for probably not just me, but probably for everybody that is investing in stocks. Do not worry. The stock market was invented in the 1700s, I just learned today. I did not realize it was invented that long ago. I thought it was around the late 1800s, and I think it was like 1792 or something. I was like, wow, that was a long time ago. So last 200 years, stock market has went up. We experienced 5% pullbacks, 10% dips, 20% market crashes. It happens. As long as you're invested in good companies, I have no doubts in Google, no doubts in Amazon, no doubts in SoFi. Completely comfortable with this. If anything, I will be buying more soon if we keep dipping. If not, I will ride this wave right back up. So that's an update for you guys. Sorry for it being like 11 or 12 days or whatever it is. But peace. Enjoy the weekend.